Hi everyone, welcome back to InfoCraze, your go-to channel to learn accounting and finance in the simplest possible way. I have made this video for all those who are very new to accounting and wants to understand the accounting fundamentals in a very simple way. In today's video, we will talk about the key assumptions on which accounting is based. One of the key assumptions which forms the foundation of accounting is business entity concept. According to this concept, the business is treated as a separate entity from its owner. Accountants should treat a business as distinct from its owner. In order to understand this better, let's take an example. Mr. John starts a new bakery business and named it as John's Bakery. To start the business, the bakery needs rupees 10 lakhs. This money is arranged from two sources. First, a contribution of rupees 6 lakhs from John, and second, a loan of rupees 4 lakhs taken from the bank. How is it recorded in accounting from the bakery's point of view? Assets of rupees 10 lakhs, which is basically the cash balance available with the business, and liabilities of rupees 10 lakhs, which include the owner's investment, that is capital, of rupees 6 lakhs and bank loan of rupees 4 lakhs. Thus, the John's Bakery has rupees 10 lakhs in cash as its starting asset. The liabilities are of rupees 6 lakhs owed to Mr. John, which is an internal liability, that is owner's capital, and rupees 4 lakhs owed to the bank, which is an external liability. Thus, even though John owns the business, from the accounting point of view, John's Bakery owes rupees 6 lakhs to the owner Mr. John, just like it owes rupees 4 lakhs to the bank. Thus, the owner and the business are treated as two different entities in accounting. It ensures that the owner's personal transactions are not mixed with the business transactions. This makes the financial statements reflect the true financial position of the business alone and helps investors, lenders, and stakeholders make better decisions. Next up is the going concern concept. This assumes that the business will continue to operate for the foreseeable future and it won't shut down or liquidate its assets anytime soon. In our current example, let's assume that John's Bakery buys an oven for rupees 1 lakh, which is expected to be used for 5 years. Even though John's Bakery has just started and might not make huge profits in the first year, the accountant will still assume that the bakery will continue running for the next several years. So, in year 1, the oven's cost is not treated as a full expense. Instead, it will be booked as a fixed asset, and only the depreciation amount will be booked as an expense. Thus, because of the going concern assumption, John's Bakery's accounts show the oven as an asset and spread its cost over 5 years. This reflects the realistic expectation that the bakery will continue operating and not shut down next month. It helps in accurate profit measurement and long-term decision making. Now, let's talk about the consistency assumption. This means that once we adopt an accounting method like how we calculate depreciation or value inventory, we should stick with it every year. If John's Bakery uses the straight line method for depreciation, it should continue using it unless there is a valid reason to switch. This helps users of financial statements compare performance over different years fairly and consistently. Next one is the accrual concept. According to this, the effects of transactions and other events are recognized on mercantile basis. That is when they occur, not when money is received or paid. Thus, all financial transactions are recorded in the accounting periods to which they relate to. Let's take an example. Suppose John's Bakery sells pastries worth rupees 10,000 in June, but the customer pays in July. When will the revenue be booked? Revenue will be booked in June even though the collection did not happen in that month. Why? Because that's when the transaction of sale happened. Next one we look at here is the periodicity concept. This means that the financial statements are prepared for specific time periods like monthly, quarterly, or annually, even though the business is continuous. If John's Bakery operates for 20 years, it is not desirable to measure its performance and financial position only at the end of its life. So, a small period is chosen out of the long life cycle of the business entity for measuring its performance and financial position, which is generally 1 year period. In India, we generally follow an accounting period from 1st April to 31st March, which is called the financial year. Hope you have understood all the concepts that we discussed today. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.